Hello, my name is Sherri Ingle with Intracoastal Realty, and I'm here today with David Macaione at TowneBank. And today we are going to talk about interest rates and what all goes into it. And essentially, I'm going to interview David because he is by far the expert in this area. So you ready?
I'm ready.
All right, let's do it. So can you provide a simple explanation of how residential mortgage interest rates are determined?
Sure.
Let's start there.
So I'm gonna say that we're going to talk about agency loans, Fannie, Freddie, FHA, VA, not bank stuff and not credit union stuff. Basically, they're traded as mortgage-backed securities, and the market sets the rate. And they're loosely based on the 10-year Treasury yield and the spread above the 10-year Treasury yield, because the 10-year is considered the least risky asset out there that lasts for 10 years, and mortgages last somewhere around 10 years. So that's why they use that. And so the question is, if the 10-year is the least riskiest, you always are going to get your money back when you buy a 10-year Treasury. So how much do you add to the rate over the 10-year Treasury to add for the risk of doing mortgages? A mortgage could be foreclosed on. It could pay off early. You could spend all this money to put one on the books and then it pays off. So loosely, it's based on the 10-year Treasury. That's where the big picture rates come in.
Okay. And will you explain what the 10-year Treasury is for
It's
those?
The U.S. government is borrowing money from you and me and from hedge funds, investors. When they auction money off all the time, they auction bonds, and they're borrowing money at 10. They borrow money for weeks, for 1 year, 2 year, 3 year, 5 year, 7 and 10 year, and 30 year. But the 10 year is the one that is closest proxy as far as time to the 30-year fixed rate mortgage.
Okay. All right. So what factors influence the interest rates offered to home buyers?
So directly to home buyers. So again, the market is going to set the rates today. So, the 30-year fixed rate may be plus or minus 7, but that's the market and where the 10-year is. But when a home buyer comes to me, it depends on what type of loan they're getting, FHA, VA, USDA, conventional. And so the government rates are a little bit better because the insurances, they're considered to be insured by the government, so the government backed a little better. But what goes into it is credit score, the occupancy, and the loan amount. So everybody in the mortgage industry, everything, all the profit and everything is based on loan amount. So you're going to get a little bit higher interest rate on a smaller loan amount than you would on, say, a $600,000 or $700,000 loan.
Okay, say that again. So if someone's only borrowing $100,000, they're going to have a higher interest rate.
A little bit.
Simply because no one's making as much money.
Right. They're not looking at the dollars. You may be paying 7% on a mortgage on a $600,000 mortgage. That same person may be paying 7 on a $100,000 deal. They may be paying 7 1/8 or 7 1/4. Just because you're not making anywhere near as much money as a lender on a $100,000 loan.
Got it. So are you saying that a property, that if someone's borrowing, say, $600 versus $100, they're going to have a little bit of a lower rate? If everything else is equal as far as their debt to income and their credit score?
Their credit score, right. If everything else is equal, well, it really depends. Because I do loans all the time for someone who buys $1 million house and only borrows $100,000. It's all based on the loan amount.
Got it. Okay.
Yeah.
All right. Very good. All right, so let's talk about market influences. So how does the overall state of the economy impact residential mortgage interest rates?
Just to put it bluntly, things that are bad for the economy are good for interest rates, and things that are good for the economy are bad for interest rates. And then to take it one step further, it's about inflation. So in a weakening economy, in theory, you should be seeing prices not going up as fast or even coming down. And in a strengthening economy, you should see prices going up. So everything is about inflation. So if you're investing in mortgage-backed securities or you're investing in the 10-year Treasury, you're trying to make a certain spread above the rate of inflation. And so as inflation rises, rates are going up. As inflation falls, rates are going down, which we've seen a classic example of over the last 2 years. Inflation, the whole thing was about inflation.
How long has it been since we've really seen inflation?
Well, besides the last 2 years, 1981.
That's what I thought. It felt like it'd been a really long time.
And that's where interest rates peaked. And then they've done nothing but come down for the last 40 years.
How about that?
Yep.
Okay.
But we've seen that bottom. The bottom, if you look at a chart, not to get too technical, but the people that watch technicals, we've clearly broken that downtrend.
All right. So can you explain the relationship between the Federal Reserve's actions and mortgage interest rates?
Yes, the Federal Reserve only loosely impacts the 10-year Treasury.
Okay.
That would, to not get too technical, and you can actually see, well, we've seen interest rates come down 1% in the last month, and the Fed hasn't done a thing. And we saw rates start to move up before the Fed began raising interest rates. So the market will anticipate what the Fed's doing, but they're all anticipating inflation. So now the anticipation is the Fed just last week said they went from we're going to be higher longer to we may cut rates 3 times next year. And that's because they're seeing things that are impacting inflation. In the end of the day, it's all about inflation.
Okay.
So that's why the weaker economy should bring, and that's what the Fed's trying to do by raising interest rates rapidly. They're trying to slow the economy down. So it's kind of bitter medicine. Higher rates lead to lower rates. Yeah, eventually. And we've seen it. We've peaked out at 8 twice, and now we're below 7, depending on credit score and loan amount and loan type. So, the Fed will, we've already seen a big rally in interest rates, and the Fed hasn't done a thing yet. So the market tries to anticipate what the Fed's going to do.
So in a way, are all these decisions based on speculation?
I mean, the people that are buying mortgage-backed securities and bonds are not speculating. The bond people are supposed to be the smart guys in the room. They're not, they're not buying stocks. They're buying bonds. They're expected to make a certain spread above the rate of inflation, and at the end of the 10 years or whenever the bond is up, they're supposed to get their money back. They're not supposed to take risk and lose money. It's a certain spread.
Yes. Gotcha. Okay. So let's talk about some credit scores and the rates that go with that. How does an individual's credit score affect the interest rate they can qualify for a mortgage?
Well, we're gonna put a grid up on the video when in edit, and it basically it's a combination of how much you're putting down, which I think we'll get into, versus your credit score. So Fannie Mae, very loosely, 740 and above, you're going to get the best rate. Some investors will have some adjusters for 780 and above, but 740 is really where it tops off, and then 720. I'm really kind of talking conventional here.
Okay.
720, 700, 680, and you can see right here on this chart where if you were to look into these numbers, you'll start seeing things really start to jump up, especially under 680. Now, this chart is just conventional. Now, when it comes to, at a certain point, when you get under 680, as a loan officer, you just know that most likely FHA is going to price out better. And so there's not a grid for this for FHA. It's that's a whole different animal. But this is conventional, and basically, as your credit score declines, you're going to pay a higher interest rate, and to a point where eventually you're going to end up with an FHA loan, which FHA is generally speaking at the same credit score, considerably better, and the PMI can be better as well on FHA. It's just that you have a funding fee of 1.75%. So
with FHA.
Right, and FHA has lower loan limits as well, which have gone up quite a bit. They're just under 500,000 right now.
Which is pretty remarkable.
It is.
Yeah, I believe they were right around 300 back when I started in 2008.
Yeah, and I think they went down after the financial crisis, because I remember they went down as low as like 260 after the crisis, and now they've come up quite a bit. So generally speaking, the lower the credit score, the higher the interest rate.
Is there ever a time that you see someone that's putting, let's say they're putting 5% down on a conventional, and it makes more sense to go FHA versus conventional, or is conventional typically better overall with the fees and mortgage insurance? If
a good loan officer is thinking conventional, that means they've got good credit, and they're probably going to price out better. When you take the MI, the PMI, which technically in FHA world it's mortgage insurance premium, between the rate and the MI, if you have a 740 credit score, even above 720 on a 95% loan, it's probably going to price out better when you combine the MI and the rate on a conventional loan.
Okay. Now, in case we have someone in their 20s and they're the first time watching, tell them what MI stands for.
Mortgage insurance.
So anytime you put less than 20% down, you're going to pay mortgage insurance. And the purpose is you're more of a risk to the bank.
Right.
So therefore, they're going to charge you for it.
And to get into the weeds, if you look on this chart and you look at the loan price adjustments, they're kind of hard to find. You will find that there's actually, you pay a little bit higher rate these adjustments, there's a little bit higher adjustment at 80% loan to value.
Okay.
So if you put 20% down, it really works out to be about a quarter in price, like $250 on a $100,000 loan, because that's the highest loan to value where you have no PMI. So Fannie would rather have an insured loan from 75 to 80%, and then that price adjustment goes away at 75% loan to value.
Okay.
Yeah. So now here's the difference. You said 20% down, which you're correct in conventional. On an FHA loan, you pay PMI no matter how much you put down. And the reason you would do that, why would you put 20% down on an FHA loan? Let's say you just wanted to, but it's because usually in that situation there's a foreclosure or a bankruptcy that is, FHA is much more forgiving on the time frame.
Yes.
Yep.
All right. So number 4, let's talk about this. Types of mortgages. What are the main differences between fixed rate and adjustable rate mortgages in terms of interest rates?
This is a kind of a interesting question for me right now, simply because, and I wrote it down on the top of this sheet, the 1-year treasury right now is at, today, was at 4.997%.
Okay.
The 10-year treasury was at 4.959. And the 1 year just a month ago was much, much higher in rate. And most mortgages are priced off the 1-year treasury. So you actually had the short-term interest rates higher than the long-term interest rates, which is a classic indication of a recession. It's called an inverted yield curve. And so for people that in our world, which is doing mostly correspondent lending on agency loans, our ARM prices are not that good.
Okay.
Now we have a bank, we're affiliated with a bank that has ARMs, but due to the liquidity issues that occurred with those banks in California going down, our attitude right now is we're keeping our money, unless you have a bunch of money in the bank. So our ARMs are priced as if we don't want them, okay, as a bank. Now you've noticed in the last 2 years, the only people that have had good ARMs are the credit unions, and that's because they have they keep their own money and they loan their own money. They don't sell them. And they needed something to do, and this is a time where they stand out.
Got it.
Yep.
Okay. And how do factors like loan term and down payment size influence the interest rate on a mortgage?
Well, back to this chart here, you can see that if you put greater than 30% down, it's actually 30 to 40. All the credit issues and the loan type issues all go away. At a certain point, a down payment on a conventional loan, they don't charge you all those adjustments once you put a certain amount of money down. But then, and as far as the loan term, generally speaking, a 20-year loan is a little bit cheaper as far as rate than a 30, and a 15-year is a little cheaper than a 15, and a 10 years cheaper than a 15. So the shorter the term of the fixed rate, generally speaking, the better rate you're going to get.
And how often are you seeing 10-year? I've never had a client have a 10-year note.
Only in refinances. I've never had one do one on a purchase, but I've had people that are past clients of mine, and we've done a refi and maybe another refi, because many people have refied over and over. And then finally, when the last time I called, like we're at the bottom, and we did a 15-year before, and now they want to do a 10. Now, I only recommend that for people that are, their kids are paid for, they're retired, they've saved for retirement, they have no debt, and they just have nothing better to do with their money.
Okay.
That's where tenure comes in.
Makes sense. All right, so now let's talk about down payments and loan to value. So how does the size of a down payment affect the interest rate a borrower might receive? Again, these are repetitive questions, so forgive me.
Well, I think what we're doing is we're looking at the credit score, and the credit score on here, it's all together.
Yeah.
You can see that this grid has both the credit score and the down payment as part of the same grid. So generally speaking, at the same credit score, you're not going to have too many add-ons until you get to that. See how right there at 75 to 80?
Yes.
So that's the first loan that is not insured. So all of a sudden, boom, you're paying a little bit extra, and then it's consistent. It really doesn't change that much.
As you go up.
Yeah.
Yeah.
So what really impacts it is credit score. That's the big impact. Although eventually a big down payment will wipe out all of the add-ons that for credit score. Eventually they're like, all right, you're putting 40% down, so we're not going to charge you for your 680 credit score.
Got it. So this is another thing that we as agents are always wanting our buyers to talk to a lender early, and people are hesitant on a regular basis. And if they could just talk and discover, what if they had a 710 credit score and just a little bit of this and that, they could find themselves at 780.
Well, you know me. When you tell me you're going to send someone my way, I'm like, get them to call me now. And you know, it's not about trying to get the business right. This is the main reason.
Sure.
There are people that think they have perfect credit, or they're looking on Credit Karma, and they don't. They think they do, and they don't. And I can usually tell people to make one or two little moves, and it will increase their credit scores.
Let's talk about that briefly. So a consumer credit score is very different from a mortgage credit score, and the average person does not understand that. So explain that.
It's just a whole different model. It's that simple. The car industry uses a different scoring system than the credit card industry, and the mortgage industry uses the toughest one. And it's that simple. I mean, if you tell me that your Credit Karma score is 780, I would bet you that it's going to be 730, 740.
Okay.
If you tell me it's 680 on Credit Karma, I bet you're at 630 when I pull your credit.
Okay.
And everybody thinks that getting a mortgage hit on your credit is some big horrible thing, and it's going to pull your scores down, and it's just not going to. You know, what's going to pull your scores down is if you go and apply for a bunch of credit cards or consumer debt all at the same time. And even then, you can have 10 different mortgage companies pull your credit, and it only shows as one inquiry, or it only impacts as one inquiry. It'll show all the inquiries. They know you're not out trying to get 10 different mortgages.
Sure.
Yeah.
And what kind of hit is it?
It's about 4 or 5 points.
Okay.
And it immediately will fix. They know that you're not out trying to get a bunch of credit cards.
Yeah, absolutely. All right. So, can you explain the role of the loan-to-value ratio in determining interest rates?
Well, I mean, per that chart, you know, it's the loan-to-value is it's not that big of a determining factor unless you have lower credit scores. You know, you can see on this chart basically from 80 to 97. Actually, at a 97% loan, you can see that it actually goes down. That's greater than 95, simply because Fannie Mae wants to help the low down payment type loans. Now, to get that current pricing, you actually have to have a certain income limit. But then you'll notice if you go down here, as your credit scores go down at any given loan to value, you can see that the add-ons go up.
I see.
Now, of course, with FHA, it's not quite as drastic. With FHA, most people only put 3.5% down. I very rarely do any type of loan with a large, or FHA loan with a larger down payment. So, you know, it's pretty much the same at a given credit score.
Absolutely.
Yep.
All right. So what is a rate lock, and how does it protect borrowers from fluctuations in interest rates?
A rate lock is simply a commitment by the lender we commit to you that your rate is good for 30, 45, or 60 days or longer. And there's no law, it's just, you know, it's us doing business as honorable people, as, you know, what's the word that I'm looking for? You know, we keep our word, and you will find times when interest rates make crazy moves. Lenders will not honor locks at some time. I mean, not TowneBank, but it happens. What we do then is we hedge. We say, all right, we just took a $500,000 loan that we have to close in 45 days. So we hedge that over the next 45 days, we may make or lose a little money on that hedge, but it's because we're making or losing money on that lock. So we've committed to give the borrower a certain rate for a certain period of time.
So if someone wants to extend a lock, let's say they're shopping for a house and they lock for 45 days, one house falls apart, they're now under contract on another one, but it's 60 days. Is it going to cost them money to extend that for 60 days?
The lock's only good for the original property.
Okay.
So
I see. Okay.
Yeah, you have to relock. Now, we can extend a lock if someone comes, if they say we're closing in 30 days and it turns out to be 45. It all depends on the market. If the rates have gone up a bunch, we're probably going to charge you a quarter discount point to hold that rate for another 15 days. Mm-hmm. But if the rates have gone down or stayed the same, we may not charge you. It's all based on the market, because we don't know what's going to happen. But and people will ask the question, well, what happens if rates go down in the meantime? And there's no good answer to that. And if you talk to any lender, they'll say, well, we're going to renegotiate if rates go down more than a quarter, and we're going to meet you somewhere in the middle. That's the honest answer. Mm-hmm. Anybody that tells you, oh yes, we'll give you this much, when it comes time to actually when it comes time to actually do it, you'll find that a lot of lenders don't honor that, or whatever they've said. You know, we'll give you an eighth if the rate goes down an eighth. No, there has to be. We've committed to a rate. We're going to lose money if we don't deliver that loan. It's part of doing business. Some people could just walk away. There's no commitment. They could go somewhere else if they have time. So we try to do what we can, but now we're mitigating losses.
Makes sense.
Yeah.
So are there any considerations or strategies borrowers should be aware of when deciding on a lock? It really comes down to, are you ready to buy a house or not?
Yeah, I mean, right now, I mean, I would have told you at 8% that you might have had a good chance to. I mean, it's either float or lock. Do you float or lock? Are you gambling? Are you going to watch and worry about it every day if you don't lock in? You know, a lot of loan officers take it upon themselves to try to guess what's going to happen. I would never advise someone to float on my advice. I'm like, look, if you want to float, you can, you know, but it's on you. And some people will call me every day. What's happening?
So what does a float?
It means you're just not locked in.
You're just not locked in. You're just out there, and you're just waiting for the right house, and then you'll lock.
And I had a couple people do that in the last 30 days simply because they were not closing for over 60 days. And beyond 60 days gets expensive.
Sure.
So it's kind of, you're not really taking a gamble. It's, if we get within 45, all of a sudden that higher price, even if rates stayed the same, you're actually gaining an eighth in rate. So plus, you know, when you've been doing it as long as I have, you kind of get a feel for what rates might do, not every day, but at a turning point. And we felt there was a turning point coming only because rates were hitting, the 10-year was hitting up against 5%. And you just felt that seemed to be the top, and which turned out to be right. And we didn't know that the Federal Reserve was going to really add to that by really pivoting, saying, all right, we're cutting rates 3 times next year. Chances are. But they won't if inflation comes back. I'll just throw that out there.
Sure. All right, so let's talk about this. What advice do you have for individuals looking to secure the best possible interest rate on their residential mortgage? This is just good old common sense, people.
I would say first, listen to your realtor. And second of all, I mean, I'll tell you sitting right here, TowneBank, for instance, we're not going to be the best rate every day. We're not going to be the worst rate every day. And there's more to interest rates. You know, I know that's what we've talked about all day today, but there's more to it. You know, there are lenders out there, mortgage brokers in particular. They're working on a shoestring budget with no staff, and you may not close on time. And I can assure you, if you go to a broker, they're going to use an AMC, an appraisal management company. You may have an appraiser come from Fayetteville to appraise a house on Wrightsville Beach. So I think there's more to it than rate. So you use someone who your realtor recommends, and you know that's going to be someone reputable, which is important. May they be an eighth higher than some broker working out of their basement in Pocatello, Idaho?
Maybe so, yeah. Well, I would say one of the most important things is something that it's a drum I continue to beat is go ahead and talk to your lender.
Yeah.
Let's figure out where your credit score is, what you can do to improve it, because people get shocked because their consumer score is pretty good, and then they discover that there is I had someone recently, and I think there was some medical, and then there was a co-signing of something, and that brought it down.
Oh, there's all kinds of things. You know, if you can have what do they call it, the authorized user can bring credit scores down, or it can bring it up. It depends on whether you're the actual card holder or not. You know, here's the biggest issue. In fact, someone you and I both know, you know, they were talking about, and you were in this situation not long ago, not that we talked about it, but when you have children going to college, you know, they need to, now I'm going to get off the tangent of interest rates, but they need to get credit cards. You know, but there are some parents that get their children a co-signed credit card and let them take care of paying the bill. And if they don't, it's going to hit you, you know, if they don't make a mortgage payment. We do many, many loans for borrowers where a adult child, or, you know, the parents are co-signed, but the bill is going to the house where the parent, where the child lives. And if the parents aren't watching and making sure that person isn't making the mortgage payment or is making the mortgage payment on time, it's going to impact their
credit card payment.
Yeah.
You mean credit card payment, not
Well, I
mortgage.
was talking about mortgages too. Like,
oh, okay.
If you co-sign on a mortgage. If I co-sign on a mortgage for one of my children and I wasn't living there and getting the bill, I would want to somehow monitor that.
Make sure everyone's
If you're co-signed for someone, if you are a co-borrower for someone on any kind of debt, if they're late, you're late too.
Good to know.
Yes.
That's good to know. So how can borrowers stay informed about changes in the mortgage market that may impact interest rates?
Well, I mean, if they turn the TV on every morning at 8:30 to watch CNBC, they can see what the 10-year Treasury is yielding. So if let's say you want to start watching what mortgage rates are doing, and they actually have a ticker on there for the 30-year fixed, the 15-year fixed, and the jumbo loan. Now they're national averages. They're probably going to be a little higher than what I could get you today. But that's a good. Let's say you call Sherri Ingle and say, hey, let's start looking at houses. They start looking for 60 days. If they right that day, they look at the TV and say, oh, the 10 years at 4%. Well, if they see 3 weeks later that the 10 years at 3 3/4, they know rates are going down.
Gotcha.
That's a good play. Or, it's on Google, it's on Yahoo. Follow like that chart that I just got for you. I just Googled 10-year yield and it came up. But that's what you want to watch.
Gotcha. Well, and in my world, I would rather just call you
That's fine.
and say, David.
That's fine.
Tell me the latest.
I would. And what's interesting about that, though, one point that I was going to make about interest rates is that when a client calls, and I try not to quote interest rates right away because I want to know where you work. I want to know all these different things. I don't know what your credit score is. When someone says, what's the rate today? I'm like, well,
it all depends.
It all depends on a lot of different things. For me to just say what the rate is could be misleading. I would need to know your credit score, your loan type, loan amount, down payment, all those different things.
Do you ever say worst case scenario where your credit score is, what's it, 580s? Isn't that the lowest you can do for FHA?
We wouldn't do it.
You wouldn't do it?
No.
Yeah. 600 then? What's the lowest?
620 is
620.
Where you're below 620, you run into all kinds of problems.
Sure.
So at 620, that people do them, people say they do them. I've worked for companies that did them below 620, and I've only done 3 or 4 in 38 years. Because normally, once you get below 620, you turn into what's called a manual underwrite, and usually people that have below a 620 credit score don't hit all the other matrices for getting a manual underwrite. Like if you do an FHA loan and you're below 620 and you don't get an approval, then it gets downgraded to a manual, and then instead of having a 55 back ratio, you have to have a 45 back ratio. And then where on a regular FHA, we don't have to verify your rent history, now we do. Then you have to have reserves. There's just a lot of things that you have to have once it becomes a manual underwrite.
Because what your credit score is communicating to the bank is whether or not you're going to pay back this money.
Right, which is a 600 credit score says you don't pay your bills back. But yet we'll still try to get you a mortgage. At least some people will. We will.
Yes.
What I'm going to do is do everything I can to get you from 580 to 620.
Sure. Yeah. And really, you all have a program for people that have low credit to kind of educate them.
We have someone who will help you get your credit scores up if possible. Sometimes they run it through the system, and sometimes it's for people with good credit. I have a doctor right now, and it's just a refinance. He's never paid a bill late in his life. But the makeup of his credit, for some reason, I can't get his scores above 715. And I'm doing a loan. It's just that it's costing him a little bit in price. I thought it was going to be an easy fix, but it turned out not to be. So, but usually if you're down at, on credit fixing, if you just have a lot of bills that usually it's getting credit card balances down is the easy fix. If you haven't paid your bills on time in the last 2 years, that's just time. Time's going to heal that wound.
So pay your bills on time. Put a reminder on your phone. Whatever you need to do.
Exactly.
Yeah, set them up on auto. All right. Well, this has been educational. I tried to have my questions fairly simplistic.
You did.
So that some 20-some-year-olds who are just trying to understand how it all works could comprehend it.
Well, we kind of went off on a tangent about the credit scores, but it's all part of the pricing, and that's the thing. One of the biggest issues, and maybe we should have a show about that, is what can young people do to prepare to buy a house? And the first thing is to get credit.
Sure.
I see 22-year-olds that don't have any credit. It's like as soon as they're 18, they should get a credit card.
2 credit cards.
2 credit cards.
But don't you carry a balance on them.
Hey, Dave Ramsey.
All right. Thank you, David.
You're
we
welcome.
appreciate you.
Thanks for coming over, Sherri.
I've enjoyed it.